Hi guys, today I want to talk about 4 investment ideas, that is 4 companies that I think are severely undervalued currently, and I think they're all gonna grow across the next couple of years, and now is one of the best times to get in and buy them. The first company we're going to talk about today is Carlisle Companies. Carlisle Company is a diversified American company that designs and manufactures a wide range of engineered products. I know it sounds very vague, but that's literally because the company produces so many different products for different industries, including high-performance optical fibers, wires and cables, commercial roofing products, building envelope solutions, a wide range of powders, sealants and other construction materials. It also provides engineering and certification services as well as integrated system solutions for pumping and mixing of coatings for automotive industry. Essentially, overall, the company produces products to some extent for agricultural, food service, automotive, construction and aerospace industries. I know it sounds very impressive, especially considering the company in total has 240 companies registered under the name Carlisle Companies. To top this all up, the company also does all of these things worldwide, so if you did have any questions about using this company for your portfolio diversification, they should all be answered at this point. Moving on to the company financial statistics. The company PE ratio is 14.9 compared to 15.2 of industry average, so it's slightly below the industry average, which is obviously a good sign. Also, according to discounted cash flow model, the company is about 24% undervalued and its one-year analyst price targets is plus 33% to the current share price. In fact, analysts seem to be in very good agreement about this target share price. You can barely see any disagreement on the graph here in light green. All the financial resources that I checked, of all of them, no one seems to think the company's share price has any chance of going down within the next couple of years. Also, in the past, in fact for the past 4 quarters, earnings per share consistently beat its analyst estimates, so there is a chance the actual share price in the future will be even more than what analysts currently predicting. If you pay more attention to the current state of matters, the company's profits margin is 13.48% compared to the profits margin of construction and engineering of 1%, electronics of 5.7% and building materials of 4.3%. This already sounds quite incredible. Quarterly revenue growth is 36% and quarterly earnings growth is just over 79% year on year. To top this up, as if it wasn't enough already, the company offers 1.19% dividend. Yes, it's not super high dividend, but it is super stable and it's been stable over the past 10 years. The 2 issues that I could dig out for the company is quite high level of debt. Honestly, this is a bit of a stretch. The current ratio is 1.78 and the debt to equity ratio is just about 96%. Both of them still quite good. Assets outweigh the liabilities and debt to equity ratio is lower than 100. The second issue is the earnings actually forecasted to decrease at the end of 2022 and beginning of 2023. So if you're willing to wait longer than these 2 quarters, you will see some nice growth in the future, but it wouldn't be for the next 2 quarters. Potentially you might want to buy the shares a bit later, just in the beginning of 2023 or just at the end of 2022 to get the lowest it could be. The second investment idea I want to talk about today is Coca-Cola. The company doesn't need much introduction. It's an American beverage company, mostly famous for its Coca-Cola drink. The reason it made it to the list today is this: dividend king with 2.76% dividend is actually about 15% undervalued according to discounted cash flow model. The definition of dividend king means the company increased its dividends consistently over the past 50 years or more, and Coca-Cola is actually the highest paying dividend king from all of them. It's worth noting though that not all the models consider the company undervalued. Some of them, like the one here, actually think the company is too expensive to purchase right now. The one-year average estimate target price is plus 4.5%, which obviously doesn't sound that amazing after the percentages of Carlisle Companies that we discussed previously, but we gotta remember about this good stable dividend and the good long-term potential as well. Also, its past 1-year and 5-year earning growth beat the market and the industry average by some amazing amounts. The company's biggest issue is its level of debt, and unlike some other companies that we discussed previously where the level of debt is bad but not horrific, this one is actually quite bad. The debt to equity ratio is 168%. In the company's defense, I can only say it's actually decreased over the past 5 years. It decreased from 222% to 168%, which is quite a substantial drop, to be fair. I know the argument, it's not as bad as it was, is not great, but it's the only one I can share in here. Also, the company share price could have been cheaper. Ideally, we'd want it a couple percent cheaper than it is now, but I still think it's a good price to buy right now, and it's still gonna grow within the next couple of years. Another company you don't want to miss right now is Google. The company's PE ratio is 18.1, which means it's currently 45% undervalued. For a tech giant like this undervaluation number may not repeat itself for years to come. 1 year target price is plus 37.5% from its current share price, and also, unlike the other giants in their respective industry, Google's level of debt is quite good as well. The debt to equity ratio is just over 10%, which actually sounds even better after hearing the horrible debt to equity ratio numbers for Coca-Cola Company before. The major caveat for the company is the company's quarterly earnings actually decreased by 26.5% year on year for the previous quarter. The company announced its results just over a month ago, and investors weren't impressed with them, to say the least. The company has actually been missing on its estimated earnings per share over the past 3 quarters. YouTube revenue was down when analysts were actually expecting a 3% growth. So why am I saying all these horrible things and still stating that the company is one of the best investments right now? The reason is the tech industry was booming over the past couple of years due to pandemic, as we all know, and the numbers we're comparing with right now is actually this super high earnings caused by one-in-a-lifetime event. Add to this the financial crisis, the energy crisis, the crazy inflation numbers, and you realize the fair price of Google is actually much higher than it is now. Philip Schindler, the chief business officer for Google, said the company saw some pullback in spend on search ads in certain areas such as loans, mortgages, insurances, and cryptocurrencies. All of those for obvious reason. The financial sector has seen some crazy volatility over the past year, and the cryptocurrencies market has seen one of its biggest crashes ever. Another key takeaway from the Q3 report is that Google Cloud revenue increased more than expected to $6.9 billion compared to $5 billion in the previous year. In my opinion, as companies move to the cloud to lower the costs caused by energy crisis, Google Cloud will become more and more popular, and this is one of the biggest advantages of the company being diversified across different products and services. And it's probably hard to find a company as diversified as Google. The company's share price may drop even further within the next several quarters as the financial situation worsens. However, I think it will increase within the next 2 to 3 years. And the last investment idea for today is Stride. Stride is a technology-based education service company which provides courses and software for individualized online learning. Stride actually has an incredible profile, being about 83% undervalued according to discounted cash flow model, with the 1-year analyst price targets of plus 60% to the current share price. The industry of online learning has been growing in general following COVID, and obviously is the one to watch within the next couple of years. Stride, one of the biggest players in this industry. The main reason the company's share price looks so attractive right now is because of its latest quarterly report. The EPS values were lower than the analyst estimates, and they were already negative to begin with. The company revenue dropped, and it was actually losing about $22.7 million. After this news, the company's share price plummeted by 35%. So why was this quarter so bad when the previous quarter seemed pretty positive? The answer is the total enrollment dropped by 8.3%, mainly because of the general education section aimed at kids from the kindergarten to the 12th grade. At the same time, the enrollment for the adult learning section, career learning section, that aimed at the middle, high school kids and adults has increased by about 46%. Overall, the revenue still increased by about 6% year on year. Despite the bad news, the company is now heading towards its 7th year of the revenue growth. 7th year means the company has been growing even before the pandemic, when this whole online learning industry has become in demand. And the shift from the general education enrollment to the career learning and adult learning enrollment seems only natural to me now that the pandemic is over. The children are back to school, so obviously the online learning for them are not as necessary as before. However, this increasing numbers in enrollment for career learning and adult learning means the company still can bring profits and still generating revenue even now when the pandemic is over.